I will now call the meeting of the retirement board to order. First up, any board communications received? No, sir. Me either. Okay. Finance director report. The esteemed G. Morrison coming to come on up.
How is everyone?
Good. How are you?
Okay. So based on the previous meeting that we had, there was a request for maybe a little bit more comparison information to be included in the packet. So I did include the normal summary that I have, but then I also prepared a Q2 to Q3 comparison, just to show the change from last quarter, as well as a Q4 fiscal 24 to a Q4 fiscal 23 comparison. Has everyone had a chance to see those? Are you comfortable with that format? Is that something that you would like to see kind of going forward with that format?
I think it's very helpful.
Okay, so no, I can talk about pieces of it. So for the fiscal 24 Q4 ending June 30th, we had an increase in revenues of about $9 million. Of that was about $7 million in just fair market value change that we report at the end of the fiscal year in June. And then the other $2 million approximately was due to increased dividends and gain loss. So if you look at your Q4 to Q3 comparison, you could see the change in the dollar values off to the side there. And then as far as the expenditures go, we are at approximately $12.3 million in total for the expenditures, which was an increase of about $3.2 million. The majority of that was, again, the pension payments, which are teetering on about or $950,000 per month. So almost $3 million for an increase there. The return of contributions was a change of about $100,000.
And just to be clear, the expenditures of like the $11 million in pension payments, that's the total through the year, right? It's not
correct. That is the, yes, for the entire fiscal year, that is that balance. Yep. That is correct. Let me touch on those pieces. And there were, so there was 11 returns of contribution. So there was a few individuals who had taken their returns of contributions. A couple of them were longer term employees, so that's why there was a higher amount.
So they opted out of the return.
As far as the FBI fees go, we had paid through the last quarter, like 2 quarterly payments. For this last amount, we are accruing for the final payment, which was for the June through the June balance, but it gets paid after the fact that it's an accounts payable. So we have 4 quarterly payments in total.
So I think on the expenditure side, it would be more helpful instead of comparing the Q4 total through the year versus where we were, just to show like how much we spent in Q3, how much did we spend in Q4, and see if our expenses in from quarter to quarter went up or not.
Okay.
Do you understand the difference?
So that is what the final column is there?
Oh, okay.
Is that what you're asking to see? The increase or decrease of?
No, it's sort of like if think about it, like we have rent of $1,000 a quarter. It would be good to show like, okay, in Q3 it was $1,000, and then in Q4 it went up to $1,500, and the difference would be $500 there, just so that we can see if there's a change in the expenses in the quarter.
Okay, I guess I'm confused. I think that, are we not talking about the same thing then? So The first column is Q4,
That's the total, right, through the year?
the balances. Okay, so you're saying just the individual quarter.
I think
Okay.
that's a more helpful
Okay.
way, because then we can just eyeball it and say, oh, okay, did we spend more, were the SEI fees more in Q4 than they were in Q3?
Yes.
Or maybe just show for each quarter of that particular year.
Okay, well, I figured this would be a work in progress.
Yeah, just
And-
because the question we wanted, the question we're trying to answer is, all right, did our expenses getting out of control? And the way that you would judge if they're getting out of control is saying, all right, was this quarter's expenses greater than last quarter's expenses?
Okay.
Not in total, but one quarter versus the other quarter.
Okay, would you also still like to see the original summary that I prepared for all the cumulative expenses and revenues to date through the fiscal year, and then have an attachment that shows?
Tell you what, rather than have everybody spend all the time, if you want, I can spend like 10 minutes with you after and just sort of give you some hints, and if
Okay.
everybody's okay with that.
Okay, that sounds good. Were there any other questions or comments on the attachment?
No. I thought I had one, but now I can't find what I was referring to. But I looked at this earlier. I think of it. I'll get a hold of you.
Okay,
Okay, thank you.
You know, I did find, okay, so I'm looking at this.
okay. the one
Okay.
that Originally,
And so on the first column with numbers here, we have a number that's slightly different than the bottom line number here. You know, it's 149,473,000 on this one, and it's 149,475,000. It's not a lot of money, but I'm just curious as to what that may be. Why there's a difference, because they're supposed to be, both of them are supposed to be fund assets as of June 30th, 2024.
okay, I think this is that's just including the second account we have, the Bank of America cash account. That's more of a reconciling item for the FEI account, and then also the Bank of America account that we have. Not necessarily the total for the revenues and expenses.
So the $2,000 difference, there's about a $2,000 difference.
That's just the value of what the cash is and the,
And you're
Bank of
saying that's the
America
Bank of America?
Yeah.
Oh, that's the reconciliation. Okay. So these are the same.
Anything else? Okay, thank you. On to approval of the minutes of the May 9th, 24 meeting. Hopefully everyone's had a chance to look at those.
Need a motion?
Yes, I do.
So moved.
Second,
Motion by Burbank, second by Oettinger.
Sorry.
And then, any comments, questions? If not, all in favor, say aye.
Right.
Opposed, same sign. Motion passes unanimously. On to authorization of payments from retirement fund for retirement benefits. Usually this is done in one motion unless you see an issue.
I do have a couple of questions. As I noted before we started the meeting, I remember when Bridget was sworn in. And I probably should know this, but on the one for Lorene Davis, she's requested a deferred retirement. And it's the date, it's July, I'm missing something here, July 1st, 2022 is her first eligible date to collect retirement based on, what am I missing here? That was years ago, that was 2 years ago.
Is it typo?
What is it supposed to be?
in the note, 2024.
So July 1st, 2024. Okay, thank you.
A good catch.
Yes.
Good
Uh,
catch.
It's a test. I know it's all a test.
Any other changes, questions?
So it just really just, and when, on Patty Franco, so she basically retired early. Is that what by a couple of months? Is that how I should be reading this?
That's
Or
better.
did she have a bunch of vacation time or leave time or?
I don't believe so, but Arnisha, can you answer that? Arnisha Green, our HR director's online. Did you hear the question?
Hi, I was actually, can you hear me?
Yes.
Okay, I was actually gonna ask Christine, I don't have it in front of me, but that would be my guess that she had a little bit of time before her eligibility.
Do we have the same typo in the note section there too?
No, she resigned, July of 2022. She wasn't in fact, eligible to retire at the time, but she was vested, so she deferred to
Okay,
her
okay.
normal retirement date, September 1st.
Yeah, and I guess, yeah, when I read the first, the third whereas, I mean, you kind of right there, you get the sense that she just notified the town of her retirement, but in fact, she did it a couple of years ago.
So is your question about the verbiage or about the actual dates?
Well, I think I understand that she retired, she left town employment in July 8th of 2022.
Right,
Before you read that note, you kind of left with the impression she's just retiring now. She's just collecting now is really the issue.
Right.
mm-hmm.
As long as you guys understand, I'm just reading it.
Christine, I think that's been the consistent language for years for this format, correct?
She is just starting.
Okay.
Sorry, I
She went-
couldn't hear you.
She went from July 2022 to September 2024 without looking at it now. She left her retirement contributions in the fund, in order to be awarded the retirement.
Or she
Right.
resigned and retired at the time.
Would there ever be an instance where somebody left before they could start collecting, that they would let us know that they want to start collecting in 2 years and we would consider that request 2 years ago and act on it, or it's just the mechanics of it.
So I guess my original question was, what I'm hearing is that the third whereas, it sounds like you're saying the verbiage, the English, the way we're using it could be written a little bit differently. And I was just checking with Christine that I think that format for this, I believe we've been consistent with that. So, and I just am wondering, are you suggesting a change to how we're writing it when somebody isn't immediately going into retirement?
Yeah, believe me, I'm the last one that should be criticizing how something is writing. Trust me, written. I just found it confusing. I
Mhm.
understand it now. And it reads as this whereas has notified the town. It sounds like she just.
Should just say is eligible, really.
Got it.
Yeah.
Okay.
So should they, yeah, she's eligible as
Yeah,
of,
it's not I just wanted to understand the mechanics of.
yeah, I agree.
The notification happened a long time ago.
Correct. And that happens quite a bit where people are not going right into retirement, and Christine works with them, as she mentioned.
Okay,
Great, thank you.
great. Anything else?
No,
If not, did we get a motion? It's like, yeah, I don't think we did. Did we?
Not for that, we have a motion. for
With the change to the Davis resolution, the 24 instead of 22 in the note.
I move we accept the 3, 4. Is there 4? 5. 5 requests.
I'll second it.
Motion by Pratt, second by Opinger to authorize the payments A through E with the change to the Davis on the year moving from 22 to 24 in the note. If there's nothing else, all in favor say aye.
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 Opposed, same sign. That passes. And then we have SCI Investment Quarterly Report. We have Pat Blizzard online.
Okay, great. I'll share the presentation here. Can everyone see that okay?
Yep.
Yep.
Okay, great, thank you.
Anything interesting happen this week?
Yeah, I was about to just throw this presentation out and just talk about the last week and a half. So a lot has changed since this was printed. So we'll touch on some of those things. And as always, I'll save some for Mark as well, because he's going to go over a market review. So I'm not going to spend a whole lot of time here. I'll get into the numbers pretty quickly. I did put some notes here. Again, some of this is dated. A lot of stuff did happen. You can use these for your minutes and the return data. So we'll get right into it here. So a lot has happened. GDP growth has slowed. So last year, fourth quarter, we were around 3.4%. First quarter really slowed down about 1.4%. And then we popped back a little bit in Q2, right around 2.5, somewhere around there. Just revised it a little bit, probably be revised again. So GDP growth has slowed. Jobs data has slowed. And as a result of that, we do have a lot of volatility that just creeped up over the last couple of weeks. A lot of that was driven by the jobs data, as well as unrest in the Middle East. Obviously, Iran, after the Hamas leader was taken out, now they're threatening to respond. So there's a lot of anxiety around the Middle East war. Not a lot of people are blaming the market volatility on that, but that's certainly a large part of what's going on. There's a lot of global uncertainty. So let's just get into some of the numbers here on the right-hand side of the page. Large cap by far is the big winner for the 1-year number, and came in second for the for Q2. Again, we talked about that several times. I'm not going to go over it too much, but really an AI tech-driven rally, Magnificent Seven, S&P 500. 10 stocks became 36% of the S&P 500. That was a couple weeks ago, before the downturn, but 10 stocks in the whole S&P 500 represented 36% of the entire S&P 500. So that's very significant. Other asset classes did well when you look at it on a quarterly basis. Small caps were the big loser. Emerging market equities performed quite well. Actually, that was the big winner for the quarter. The longer dated bonds you had, longer duration, the worse you did. So core fixed income, duration of around 6, that was relatively flat. You can't even see the bar. Long duration was negative. So the longer maturities you had, the worse you did during that period. High yield bonds added some good value. Emerging market debts were slightly negative. And then inflationary products like inflation-linked bonds, Treasury inflation protection securities did pretty well. And commodities had a good quarter as well. So all in all, it was a positive quarter. We did have some assets that were negative during the quarter, but diversification definitely benefited the plan during this period. Looking ahead to the U.S. equity market review, you can really see what happened here with the growth stocks versus value. Bottom left-hand corner, growth stocks almost tripled value stocks, which is pretty significant on a 1-year basis. And then you can see the sectors where last meeting technologies fell to the right a little bit more. Now technology, communications is on the left side of the chart, means it did better for the quarter. But there's a couple of sectors here which did well, which haven't done well for quite some time in the quarter. Utilities, consumer staples, and consumer discretionaries crept back to the left side of the chart. Those are asset classes which are really underperformed. And the main reason is there's a lot of dividend yielding stocks in those areas. And treasury yields have been so high, there's no reason to take the risk in any of those areas in the equity side of the equation where you can just buy a treasury and get that high yield. But we have started to see them perform better, specifically over the last couple of weeks. They've been the top performers. So people are moving back into dividend yield stocks, and those sectors certainly have a lot of them. So that was a big change in the markets, especially over the last 2 weeks. International equity, won't spend a lot of time here. Japan still did very well. Actually was down for the quarter, but did well on the 1-year basis. Europe actually had some pretty good growth more recently, so their economy was doing okay. But overall, the U.S. still continues to dominate international as a whole. So again, we did see some positive spots in emerging markets and developed international countries, but all in all, the U.S. still won. I just put this in here because this is somewhat good news here, and This is a purchasing manufacturing index. And you can see here that anything over that dotted 50 line, you're in expansion mode in your economy, manufacturing. Anything below, you're in contraction mode. So just going back not too long ago, you can see that back in September of 23, all the way through more recently, March of 24, a lot of countries were under that 50 line. So everyone was in contraction, mostly everybody, a lot of countries. The US is still pretty good, but all in all, now every country on this list or every zone is now in fact above the 50 line. So that's a bit of positive news. Again, are we going to have that soft landing? The Fed's done cutting interest rates. And I'll speak more about interest rates next slide. But all in all, that's a breath of fresh air because we did see manufacturing pick up across the globe. And here's fixed income. So let's talk about interest rates because a lot of what's going on with the volatility has been driven around this. So just over the last couple of weeks, if you go, let's go back to last year. So fourth quarter of last year, many economists believed we would have approximately 6 rate cuts, mostly in the first half of this year. Well, obviously that didn't happen. Inflation data came in a little bit hotter than expected. The Fed still was not happy with the data overall, and jobs were still running pretty strong during that period. With that being said, now we've seen kind of a flip of that. So jobs data came in much lower than expected. Jobless claims increased, and we saw a very poor first quarter of GDP. So that kind of spooked the market a little bit. Now the Fed is certainly probably going to cut in September, maybe 25 or 50 basis points. If it's 50, it would be very surprising. I think it'll be 25. And I do believe we'll have one more rate cut before the end of the year. It'll be interesting to hear Mark's take on that as well. So now we're looking at probably 2 rate cuts before the end of the year. I think last meeting we said maybe 1 and then maybe a couple more the beginning of next year. So a little bit different because the data came in a little bit different than expected. All in all, yields have come down significantly, specifically in the beginning of Q3 here and towards the end of Q2. So we saw yields come down across the curve. And we're also starting to see the yield curve steepen a little bit, meaning we're seeing the long end of the yield curve rates are moving up a little bit, where the lower end are either staying stable or coming down a little bit. So the spread between the 2-year yields and the 10-year yields, it might be a little bit different right now. It's changing so quickly, but it was only about 7 basis point difference. Where that's significant because that difference was much larger. So we're starting to see the yield curve inversion dissipate a little bit. We could see as we move forward a steeper yield curve and a more normalized yield curve as the Fed begins to cut interest rates. That's going to be a positive for your fixed income portfolio because as interest rates come down, the prices of those instruments will go up. So keep that in mind as well. Questions?
Pat, I think I asked you this last time, but are you doing, have you changed any, are you looking to make any changes to the duration as we kind of head into the second half of the year?
No, I think we made the moves that we need to make. We moved into shorter duration profile. So I think we're in a good position now because the last thing I want to do is go fully short where we have to take advantage of some of the long interest rates because as rates come down, they're going to be our best performers. But we're still clipping really good coupon on the shorter end of the yield curve as well. We're getting like 4.5%, 5% there. This slide, I actually spoke to it already. So you can kind of see where the market was, central bank policy towards the end of, what are the moves going to be before the end of 2024? Before 2024, you can see the US had -6 or 6 rate cuts. Now we're looking at 2. So, and that was across the globe, quite frankly. Everyone has cut rates with the exception of the US. And I think the UK may have just cut. I've been traveling a lot, but I think they just cut. So the US is the last one hanging out there that hasn't cut yet. Okay, and I spoke to many of this, so you can read through this, good news, bad news. And we'll get right into the performance. Okay, so we added your fiscal year to date column here. And the next couple slides, we have year-to-date as well. So you can see it from a fiscal standpoint and a calendar year standpoint. So fiscal year-to-date, the plan was up 12.17% gross, 11.95 net. And that slightly outperformed the index of 11.87. And so we have really strong returns the first half of this year so far. Obviously, markets have been down the last week and a half or so, a lot of volatility. It's pretty impactful when you see the Dow down 1,000 points, but you have to remember it was over 40,000. So on a percentage basis, yes, that may have been 3 or 4%, but the numbers are just, when you look at them, you get nervous, right? But the market has bounced back the last couple of days. So, I mean, right now it's looking like a V-shaped recovery, but I do expect some more volatility because there's still a lot going on out there, everything that I mentioned earlier. But still, good first half of the year. Looking down at the fund level, everything performed pretty well as a whole. Nothing really of note looking at the fiscal year-to-date column. So we'll move ahead. One thing I'll mention here is U.S. equity factor allocation. That underperformed slightly, but I would expect it to, right? Because of what I mentioned earlier. Those 7 names or 10 names, the S&P 500 driving everything higher. That U.S. equity factor-based strategy, I look at it as more like kind of like an equal weighted S&P 500, even though it's a Russell 3000 product. Think of it as like an equal weighted. You still have access to those names, those big names, but a much lower percentage. And the strategy really focuses on strong fundamentals and strong companies with strong earnings. So I'd expect next meeting, you're going to see that strategy outperforming pretty good compared to the other asset classes, because we did see a pretty big sell-off in those Magnificent Seven over the last couple of weeks. And fixed income, fiscal year to date. Couple of things I point out here, limited duration, that's shorter duration. We talked about that. So we did put a pretty significant portion, moved it to 11% or so, 12%, moved that from core fixed. So that was up 5.4%, and core fixed income was up around 3%. So that trade definitely worked out in our favor for this fiscal year. And even going back, this is it's a full year as well. So that's right. And you haven't been in limited more than a year. So that's why you're not seeing any more data, but that definitely paid off that trade. And then also increasing high yield and adding EMD also benefited the plan as well, because those numbers are higher than core fixed income. So you can see high yield did very well, 11.8%, and EMD was up 6.7%, emerging market debt. The real estate fund came back strongly. That was up 9.6%.
Just keep doing this every quarter. Just keep do this every quarter. And we'll be
Okay. All right.
Equities, fixed income, real estate, everything's up.
Exactly. So it's a good report. And that's all I had, unless there are any other questions.
So Pat, I've just a couple of questions, and
Sure.
Shame on me, I probably should know. On your cover page, and I did not go back and look at your last report. So you may have already always titled it this way, but what does OCIO stand for? The OCIO Partnership Review.
Yeah.
So we're an outsourced chief investment officer. Our program is an outsourced chief investment officer.
Okay.
So what that means is we essentially do it all on behalf of our clients. So if you think of a traditional consultant model, a consultant will come into a meeting, they'll give you recommendations. You're going to pick one of those recommendations, right? Like a manager, like manager A, B, C, and they'll come in, they'll say, okay, here are the managers, here's the lineups, here's they'll lean you towards a recommendation, but it's your choice to make that decision. So
No, it was just the acronym that was, I just
Oh.
don't remember seeing it before.
Okay. Yeah. So, I mean, that's our firm, our institutional group's an OCIO.
Okay. Second question on page 3. And again, I'm probably just missing something here. So you've got the little table on the top. It talks about fiscal year to date return 12.17, 1 year return 12.17. Looks a little suspicious that it would be the same, but down in the very first bullet, we talk about a 15.29% return during the first half of the year, which to me, I'm interpreting as what's in blue, the fiscal year to date return as of 6/30/2023. But what am I missing here?
You're not missing anything. The fiscal year to date ended June 30. So the 1-year number is the same as the fiscal year to date number.
Okay, and how does the 15.29 that's in the first bullet, what's that? Since the narrative says that's
Yeah.
the return during the first half of the year.
Yeah, that's just the S&P 500 return. So that's showing you the S&P 500 equity returns for the first half of the year. That's just a specific index return.
Yeah, so we didn't get 15.29, they did.
Okay,
Can we swap for the 15.29?
Well, if we were all in the S&P 500, you would have gotten a 15.3% return for the first half of the year.
Fixed income and the other things.
Yeah.
So.
Yeah, so you have a well-diversified portfolio, so
That's just a portion of your portfolio is the S&P
Okay.
500, probably
yeah.
20% or
Yep.
so. Yep.
So in a summary, we're just talking about, okay, what did equities do, right? What kind of drove the equity market performance, things like that. Just kind of high level overview.
Is there a question, just wondering with tech, is that expected to plummet with the Google, what's going on with Google? You know, what's the impact of that likely to be?
I'm sorry, the effect of Google?
Google, the Justice Department's initial win is Google being a monopoly. I wonder what that's doing to the tech markets.
Well, yeah, I mean, that's certainly going to have impacts on the individual stocks. I mean, Apple's being litigated overseas as well. So, you know, they're all individually going to be dealing with this. So, I mean, that absolutely could have an impact on the industry as a whole if that continues, that trend. Because you do have these companies like Amazon, Google, you know, they look more and more like monopolies, right? So Justice Department's coming after them and most likely getting some fines from them as well. So
That's built into the price.
yeah, that's all built into it.
Right.
But, you know,
Okay.
again, most of it really is AI driven right now as far as the uptrend, the uptick in that sector, those 10 names that I mentioned. So that's been a big driver, and AI is not going away. So I'm not saying, hey, let's not go in the S&P 500 because, you know, 10 stocks make up 36%. But what I am saying is we thoughtfully moved into US equity factor base because of that trend, right? Because valuations were back to where they were back in 2000 for some of these names. So it was just a thoughtful way to make an allocation change to the portfolio.
Okay.
I just had a quick question about the inverted yield curve. It
Yes.
seems like we're talking about that for a long time. It seems like a very long duration thing. Is that pretty common, or is this like an
No.
pretty extended period? Something should
It's
have
a
happened.
record.
This is one of the longest periods it's been inverted in history. So this is by no means normal, right? But you have to remember the environment we came from, right? We came from the credit crisis. We came from very easy money for many, many years, quantitative easing. You know, as a result of all that, we had an extremely low interest rate environment for years. And then the Fed, maybe a little late to the game in raising rates, then the Fed rapidly rose rates. So that created a pretty strong inversion in the yield curve, which is slowly working itself out. And over the last couple of weeks, frankly, it's really made significant progress. But I'd expect at least a couple more quarters of this inversion before it goes away.
Thank you.
Welcome.
so just, Pat, just to go back to my comment on page 3, and I understand it. But it would seem, you know, not all of us are financial experts here. It would seem, I mean, my takeaway is we would have been better off with just S&P products than where we ended up. And I know why we're not just doing S&P, but that kind of gets, to me, that gets lost in the summary here. That somehow at least drawing attention to it, you know, even if it's, you know, was a 15.29% return as opposed to the town of Groton's return of 12, just to kind of close the loop to, you know, for the non-expert, casual reader, because these are public documents. I just, for what it's worth, I just think there's a better way of presenting this information than relying on the reader for you to think that the reader is going to understand the point that you're trying to make. But that's just me.
Well, that's fair. I mean, in the future, I can add, you know, additional asset classes so you can see more, you know, I can add, you know, fixed income here. Again, I can do that for you. Absolutely.
Yeah. Pat, I think the slide, I think it's your next slide, the one where you show the custom benchmark. I think that's probably, maybe it's a few pages ahead.
This one?
No, I think you have your you know, you have the portfolio versus the benchmark returns that shows the outperformance of the portfolio as a whole.
Yeah. Yeah. I mean,
I think
again,
that's the, you know, the S&P is probably only about 20% of the town of Groton's portfolio. It's the main driver. It's the main index that represents US stocks, but that's a small part of the town of Groton portfolio.
right. And my thinking behind the way I wrote it was, you know, we've been talking about those names that have been driving markets higher and leaving everything else behind. And it's in that note that I wrote an executive summary, right? So it speaks to that. So, I mean, that's the reason I put it there, because I was going to speak generally about that. But I can add more, I can take things off. I mean, I could do whatever you guys want. But it's all right here is the data, right? So you can see large cap, you know, obviously on a fiscal year to date basis was up 23+%. I mean, quite frankly, US equity factor base was slightly under that, but it's not far off. And you're going to see that outperform for this quarter, most likely. But I can add, what I'll do in the future is I'll add a couple of different asset classes or broader indexes. So it's not just the S&P 500. You can see S&P 500, you know, international, fixed income.
Okay.
Hi, this is Arnisha. I had a quick thought. I think that was Mark who just was making the comment about how the average reader might take this. And I think it's an interesting point, and I'm turning it over in my head. One part of me says, to be blunt, this is what we're paying for, a high-level summary that's written professionally and to market norms for folks that are very educated like yourself in this to understand it. And our fiduciary responsibility, it all rolls together. But then I do think about it's a good point. Myself, the everyday average employee, can they pick this up and understand what it means? And this is where their money is tied up. And is there a solution somewhere in between that's for the layperson? And maybe that's not exactly where Mark was going, but that's what it brought my mind to about accessibility from and understanding where some might feel like this is jargon because it's not their chosen field. Is there a way somewhere, somehow, I don't know what that looks like yet, to make it a little more accessible, generally speaking?
Are we just speaking about the executive summary, or are we speaking about the whole presentation at this point?
Do we get many requests or any requests and do we have an obligation or a habit of presenting information to employees on a periodic basis to let them know what's going on with the fund?
We don't forcefully push it out to employees, but thinking about our different vehicles, and I'm going to be diving into it a little bit more, fiduciary responsibilities, that might be something to discuss for the future. So I just wanted to throw my 2 cents in there. And right now, I think it was just the executive summary that Mark was referencing, and it just got me on the train of thought that I think is good for all of us to think about as we move forward. And are there ways, should we choose to connect employees more directly with this, or if they seek it out themselves, to make it a little more accessible? I don't know what that looks like yet, but I just wanted to piggyback on that from the HR perspective of employee use and employee.
Is it true that if, say, an employee had a question that none of us could answer, would you be accessible to them, Patrick?
Would I be accessible to employees?
Yes. In other words, to answer a question that we couldn't answer?
It'd probably be
Yeah, I mean,
funneled
I
through
wouldn't-
finance or,
Yeah, I absolutely
Do
would. I
that,
wouldn't hand
yeah.
out my cell phone number, but that would be a little overwhelming at times. But absolutely, I mean, you can always email me if you have any questions from anybody. I'm always accessible to answer those questions.
People
Right,
are
and I'm
fine with
sure
this.
it would go through the chain of
Yeah.
command, but
Mhm.
Yeah.
ultimately, you would be able to give an
Yeah.
employee if they had a question that none of us could answer.
So I'm
Absolutely.
almost sorry I raised this issue. As a reader, I thought possibly there was a mistake.
Hmm.
That's the only reason I'm raising it. I thought the 12.12 for fiscal year to date versus the 1-year return, I thought maybe that was a mistake. Our fiscal year starts July 1st, I assume for the table. But then when you read the S&P comment, it talks about 15.29, different percentage. I understand why it's different during the first half of the year. Our fiscal year, which was ended
No.
last December.
No,
I mean, we're mixing, you guys, this is all natural to you. And so it's almost like, why even put the information in there? It's of really no value. Because if I truly think it's the first half of the same fiscal year that we work on, it's 6 months old.
all right, well,
And I
let's
don't
take it.
think that,
Yeah, I understand. So let's take a step back here, because I think what happened here was we just added the fiscal year to date information to this presentation, right? In
no
the
good
past,
deed goes unpunished.
yeah, and exactly. And in the past, we strictly had calendar years, so that would all sync up. So I understand what you said, right? So I'm going to word it a little bit differently as we move forward. As a resulting, added that fiscal year to date in there. So I'm going to handle that for you.
Hey, great, appreciate it. And
No
let's
problem.
go ahead and-
Thank you, Pat.
Mark? And Pat, yeah, good.
Mark is quickly rereading every document.
Yeah.
I'm deleting some pages.
What did he say?
I'm deleting some pages.
pages.
We're seeing the presentation right now.
There we
I'm
go.
gonna make this the print.
One executive summary.
Yeah, so, as always, there's generally some overlap between my presentation and Pat's. We both start with a kind of an economic summary, so I'll kind of be light on that. Just back to the question of OCIO and what, Pat explained what his role was with SageView. We are an independent advisor to kind of oversee and give a second opinion to Pat's presentation and performance as a whole. So that's kind of what we do. And we kind of look at the underlying managers of the actively managed managers in the plan. A lot of it's passively managed. They use index funds to replicate returns. So that's just to level set there. Actually, this quarter, we do have a few slides that I think Pat didn't include. We had gotten a lot of questions and, clients, different types of clients, maybe nervous a little bit about the upcoming election. The last week or two has been worry about, did the Fed mess up? Did they wait too long to cut interest rates? And, are we going to see maybe a hard landing or a recession versus that soft landing? So I won't go through this, and definitely don't want to talk politics, but I put a couple slides together just about the effects of presidential elections and markets. So, first of all, the market is up about 75% of the time. In any given year, you got a 3 out of 4 chance that the market's going to be positive. In presidential election years, the rate of return is about 10%. Probably a little less than the norm if you look back over 100 years. So this is a chart we stole from Goldman Sachs, but it just shows, little better return when the Democrats in office, 13 versus 11, and just kind of standard average years. Kind of more importantly, the controlling party of the Senate and House seems to be a little bit more important. Republicans have a better record historically. A little bit higher return when they control the Senate and the House. So really nothing can be taken from the next 3 slides. I think at best, the results are mixed. This chart shows the last 5 presidents, and then the returns of the different sectors in the S&P 500. And basically what this chart shows, it's very random. The same sectors that do well under Democratic president have done well under a Republican president. So to kind of very random. This charts were basically to dispel any rumor that, you know, whoever's in office really kind of dictates the rate of return on performance. Oftentimes the president can inherit a great economy and then the performance of the stock market does well. You know, maybe some of their policies have effect on certain industries. So there may be a reshuffling. Some active managers may shuffle their portfolio a little bit differently depending on who wins the election in November. One thing that's common is that volatility goes up in years where there's an election, right? The market hates uncertainty, and we've got a lot of uncertainty right now. Where are interest rates going to go? What's going to happen to the job market? Are we going to see a recession? Who's going to be president? And a lot of those answers will probably come in the next 6 months or so. So we expect a lot of volatility. There's a lot of money on the sidelines in money markets. That's common in an election year. You tend to see inflows into stock funds kind of slow down and inflows into bond funds go up. And, you know, kind of big institutional investors kind of waiting on the sidelines until there's some certainty around the election. So just some quick high level notes there. I think the next couple slides are Sage View's kind of committee outlook. I think this has been an interesting year. We started the year with a lot of optimism that we would start to see some rate cuts. And then, as Pat mentioned, you know, had some inflationary surprises in the first quarter. Nothing happened in the second quarter, but the economic data started to slow, and then we got the, you know, kind of big shock last week with some numbers that suggest, especially with some revisions to prior months, that the job market may be really slowing a little bit more than expected. Pat talked about AI. We saw a little bit more of a broadening rally in the first quarter, and second quarter kind of back to the reliance on the big seven, magnificent seven, especially NVIDIA. Someone asked about the yield curve. Yes, we are seeing, you know, one of the longest inverted yield curves on record. We had the longest drawdown in bonds, 940 days, although we're starting to see a little bit of a change in the third quarter with bonds doing well. This chart, you know, I think similar to the way Pat showed it, but the green bars, if you can see it down the bottom, that's the first quarter. So it was really mixed. You know, real estate was down, commodities were up, emerging markets were up, US was up, but international developed markets were down. And if you can picture, the town of Groton is kind of a combination of all these asset classes, got a little bit of exposure to everything. And that's why we kind of come up with that custom benchmark that shows, based on our allocation, which is roughly 60% equities, 40% fixed income. You know, that's kind of what we benchmark the portfolio. So a kind of a combination of these returns. Every quarter we kind of visit this. This is what our committee sees as positive, neutral, negative. So even in a, you know, Friday and Monday morning when we're watching our personal accounts maybe go down, you kind of take a step back. I mean, we still have some very good economic data. Even though unemployment went up from 4.1 to 4.3, historically, that's still relatively low. We've got positive GDP growth, we've got decent corporate earnings, and then we've got a Fed that's about to cut. So even if the economy does slow, the Federal Reserve most likely is going to have multiple cuts over the next year and a half or so that hopefully can offset the slowing of the economy. The only change, I think, I think it's the same as last time. We had moved interest rates from neutral to negative, and that's basically because the Fed basically decided to do nothing the first half of the year. I thought maybe we might be a little bit more optimistic than Pat. I think Pat was calling for 2 rate cuts. Maybe we'll have a small wager. I think our committee's leaning a little bit more towards 3 cuts. The election year could maybe stifle that. There's a big push for the Fed to cut rates 50 basis points in September, but there's a good chance they may opt just to do the 25 basis points. The big thing is we're gonna have we're gonna get 2 more jobs reports and an inflation report, or I might be getting that backwards, maybe at least 1 more jobs report and then 2 more inflation reports. So that'll definitely play into the Fed's decision. But I think we're kind of leaning a little bit towards 3 cuts in the fourth quarter of this year. This has a lot of things going on. I think it, very similar to Pat's data. This shows the major indices all represented within the portfolio in SEI. Just kind of breaks things down a little bit more granular. It looks at the NASDAQ, it looks at the S&P 500, small and mid companies, international, and kind of, the same themes that Pat pointed out. US large cap, specifically 7 stocks have really pushed the S&P and the NASDAQ higher. And we hope to see a little bit more broadening of the market, meaning we'd like to see more stocks do well and not be so dependent on just a few stocks. So kind of repeat there, and then here's our yield curve. I think I like to look at the yield curve this way. So the left-hand side of this page shows where short-term rates are, 5.25, 5.5, right? So if you invest for 30 days, you can get about a 5.5% return. If you're willing to invest for 30 years, you're only going to get about a 4.4% return. That's an inverted yield curve where you can get a better return for a shorter term investment. That's not normal. We're hopeful in a year from now, we might see that short end, down closer to 4%. We'll see what longer term yields have to say. The Federal Reserve only controls short-term interest rates. So them cutting short-term rates doesn't automatically mean that longer-term rates will change, but most likely it'll have some correlation there. All right, so that's a quick summary of what we're seeing, probably pretty similar to what you just heard. The assets are in the asset allocation, kind of back to that S&P 500. There's about 27% in large cap US stocks in the portfolio. Overall, I like to look at the right-hand chart. US stocks just under 40%, international stocks at 17%, and then a really big chunk, about 43% in US and international bonds. As we look at as a whole, so our job is to look at each individual fund. If we see a particular fund that may not be performing well over a long period of time, we may talk to Pat about maybe a replacement fund. Ultimately, SEI has that ultimate call on the individual fund selection. The portfolio has beaten its index. So basically, you're getting good value from SEI. They're providing an above average performance based on the risks they're taking. And a lot of that comes from some of the actively managed managers in the fund, in the plan, specifically some of the fixed income managers and the real estate managers. We apply a nine criteria scoring system to rate the funds. So we take each fund individually, we compare it to its competition or its peer group, as defined by Morningstar, and then we score it and give it an overall ranking in its category. So 1 is the best score you can get, 100 is the worst score. On average, the funds are in the top quartile. They're in the 24th percentile, which is obviously very good, beating on average 76% of their respective peers. And this is kind of the individual report card. So we take those 6 actively managed funds, we rank them 9 different ways versus their competition, and we give them a score. So think of this like golf, lower is better. So if you see the SEI limited duration gets a score of 27, that means it's been better than 63% of its competition. And you can see kind of the individual marks. You're not gonna get 9 for 9, maybe a fund or two, maybe 9 for 9 on different criteria. And we look at performance, risk-adjusted performance, consistency, and expense ratio. So one fund that has fluctuated a little bit. It's a very diverse category, and it's a very small category. It's the Emerging Market Debt Fund. That's a fund we added in 2022, and it's provided good returns and good diversification. But compared to a small subset over 3, 5, 10-year period, it scored kind of mediocre this quarter in the 64th percentile. It's also very different kind of from the normal peer group that you would find in Morningstar. So while we're scoring it in the 64th percentile, we put it on our watch list. Really no concerns. It's been a really good contributor to the portfolio. It's only about, Pat, correct me if I'm wrong, I think it's about 3% of the portfolio. Oh, you're on mute, Pat. You're on mute, Pat.
Sorry about that. Yeah, it's 3%. There's a couple things I keep in mind. One, it's a very different strategy than what you're seeing in the peer groups for Morningstar.
Yep.
Secondly, Morningstar does have a lot of characterization or misclassification in it. So you could have some funds in there that are just completely different than what our fund is. But what I like to really look at, and I think I talked to Mark about this, is where we took that from, right? So we essentially took emerging market debt from core fixed income. So it beat core fixed income by about 8.5% from where we took it from.
Yeah.
So from an asset allocation standpoint decision, it was a good move. So.
Yep. Yeah, we would agree with that. And it's important, you know, prior to that move, all of our fixed income exposure was in the US. And this just gives us a little bit more diversification, and not only good diversification, but it's actually outperformed US markets. You'll see, you know, 3 of the funds score just right about top decile, so beating about 90% of their peer group. That factor allocation, kind of 42nd percentile, makes total sense, right? Because it's not dominated by that Magnificent Seven. It's actually meant to do the opposite. And as this market broadens out and you see kind of a rotation out of those big names like Google and NVIDIA, you know, this is a fund that's going to provide some good diversification in the US equity market. So overall, no concerns. You know, they continue to do a really good job adding alpha. So when we say we're adding alpha, we're outperforming kind of the expectations. And that's what SEI has been really consistently doing since I've worked with you, kind of quarter over quarter, year over year, kind of adding additional performance, which results ultimately in lower contributions. That's our summary for the second quarter.
I do have a question, if you can. Starting on page 11, you had a section on litigation. Is that something that would affect our plan? Or is this nothing to worry about?
Nothing to worry about from you all. We have a group that puts together pension, retirement plan litigation. Most of the litigation you see is in defined contribution plans, 401k, 403b, 457. Periodically we'll see some involving defined benefit plans. So yeah, nothing in this quarter. Everything is kind of defined contribution focused. Target date funds, managed accounts, those are only available in 401ks, 403bs, and yeah, so nothing that affects. Good question. I should have kind of mentioned it, but I always include it in case anyone finds it interesting.
Okay. And my other question is watch list. Can you explain this investment watch list summary?
Yes. So that's back to our scoring. So let me go take a look at, this is how we look at our 9 criteria. So I'll take this limited duration bond fund for example. It scores in the 27th percentile. We want everything to score in the green, from somewhere between 1, which is the best, and 50. So we want everything to be kind of in the top or second quartile or above average. If something scores in the 3rd or 4th quartile, that's when we'll put it on the watch list. And we had the emerging markets fund that I mentioned before. Very small subset. There's only 242 peers in the Morningstar category. They score this quarter in the 64th percentile. So that's why we put that on that watch list. If it self-corrects, the last few times we've met, the fund's been in the second quartile. Once we get a couple more readings where it's kind of back in the right direction from our scoring standpoint, we would take that off the watch list.
Thank you.
And on your watch list, you highlight if it's been on the watch list for successive quarters?
Yes, yeah, so we'll date it when it's been on the watch list. Actually, that should be 6/30 of 2024. Yes, we will note if it's second time, third time in the note section.
Mark, are we due for a rebalancing? I
Yeah,
noticed
that would be a function of SEI. I think they've got thresholds where, if our allowable limits get out of whack, that they will rebalance for the path.
We rebalance on a quarterly basis. So if any fund gets out a 2% variance from its target, they will be rebalanced automatically.
Okay.
Any cash flows as well, we do smart rebalancing. So if you had a large contribution come into the plan, we would use that money to do smart rebalancing to get it back closer to target.
Thank you.
Mark, can I just say one more thing about these peer groups? Just in case I start to get calls from the employees. There's a couple of things here. Be very careful. Be very careful when you're looking at Morningstar, because if you go out to Morningstar and you decide to get a well-diversified portfolio and you choose all 5-star Morningstar rated funds, that's not to say that they're going to be 5-star tomorrow, okay? A lot of those 5-star Morningstar rated funds, they might trend down over the next 5 years and be 1-star rated funds, and vice versa. Your 1-star rated funds, they might trend up and be 5-star rated funds. So just be very careful. Morningstar is a good tool because it does give you a good gauge versus peers what's going on, but you don't want to just select the highest 5-star Morningstar rated funds and build a portfolio with it, because I can guarantee they're not going to be 5-star for another couple quarters or another couple of 5 years. So.
Totally echo that. We don't use, the only thing we use Morningstar for is the peer group, just the data. We don't use any of their star rating or anything like that. We use our 9 criteria. That's a proprietary scoring system that we built that's more retirement specific. Morningstar is really kind of a retail tool.
Yep.
And you're right, a fund that's 5-star, there's been studies that show it's more apt to be an underperformer going forward than an outperformer. So we don't, only the database for returns and criteria, that's the only reason we use Morningstar.
Any other questions? Okay, great, thanks, Mark. Move on to discussion of quarterly, wrong thing, interest rate on employee contributions. Do you want to come up just to explain that? Usually do. We just need the vote, right? Yeah, okay, we need a motion to accept and file the item.
So moved, Burbank.
Do we have a second?
I'll second it, but I do have a question.
Okay. We have a motion and a second. Questions?
So you did present this at the June 8th meeting, we talked about you. Why didn't we act on it then?
I think we were unsure if we actually had to have a motion.
Okay,
Yeah.
okay, that's fair. I mean, maybe if that could just somehow get noted in the minutes, so once again, when that phantom employee ever looks at our minutes, they understand. Why didn't you do this back June 9th?
The amount of service that person
Yeah.
had. They come and ask,
Well, really, it's me. In 3 months, I'll always say, what the hell are we doing?
Okay, we have a motion from Freeman, second by Ofinger. All in favor, say aye. Aye. Opposed, same sign. I assume that's an aye, or yes. Motion carries.
So Jen, just to, would it be possible, I mean, since we, in theory, have been doing this since 1994, would it be possible at some point to kind of get a table to show what the board has done over time? do we do this every year? Have we done it every year? And just so that, and then it would be easy to keep current going forward.
Is that hard to pull up? History on the interest rate, what it's set at for the employee contributions each year?
I don't, that's not the question, right?
Oh, was it?
I think the question, are you asking like, are there a set of things that have to be done each year routinely?
No, what I'm asking is, can we get a chart or a table
Show
that
the
shows
history of it.
basically what the percentage increases have been?
Okay.
Since, according to the memo here, this was something that was decided to be started in February 1994. So that, next year, if we consider it, we can at least say, well, last year it was 4 point whatever, the year before it was.
So I think that was one of the things I had handed out. You're talking about.
Oh, that's right. Yeah, that was provided last time.
Oh, was it? I'm sorry.
Is that what you're thinking? I have other copies if everyone wants to.
I remember, I have it in my
Excellent.
file.
Yes,
What, do
You
you want to
can
get that one? Or it is part of the other packet from last quarter.
no, I haven't
Okay.
got the packet. Thank you. Okay, so you do keep. You
Yeah.
keep it current. Great. I missed that.
Okay, any other business? If not, the next meeting is on November 14th, and I would entertain a motion to adjourn.
John, just one other thing, and I just, I mean, Carol and I are aware of this. I don't know if others are, because we participate in the town retirement program. We got a very nice cost of living increase. And my first thought when I saw it, besides thinking, thank you, because it's the first one I've received, is I would be very curious in the analysis that went into that, because this is not done very often.
Right.
Or at least, I don't think it has been.
It hasn't been historically, though. This council seems to be leaning towards wanting to do it more
And
often.
that's great, but I think it would, I mean, that ultimately does impact
Yes,
this fund, and I just,
Yeah, so that would be one thing that I would expect to
Mm.
see as we look at quarter over quarter expenses, if there was a sort of, if you were going along a
Right.
straight line and then all of a sudden
Yep.
it bumped up.
Yep.
What caused that? Oh, it's because of the cost.
I'd just be curious, I mean, I'd just be curious, I'm sure it's not gonna happen every year.
well, first of all, it's always said to be looked at every 2 years, but yes. you're
Okay, but I just think it does impact
Sure.
ultimately what we're all supposed to be responsible for,
Right.
which is the health of the retirement fund, and just understanding the hard work and the mechanics and what was looked at.
Mm.
I think would be enlightening for
Sure.
us. That's all I have.
Yeah, I agree.
How does that affect our invested, like, where our percentage is, for the.
Yeah, well, how much money and, should we be?
Liability increased.
Right, yeah,
Mm.
right.
Mark, are you asking what was looked at, meaning the actuarial review?
Yeah,
Which we have, yeah.
Yeah, I'm sure
Yeah.
there was a memo that you guys prepared and presented to council, and, the number wasn't pulled out of thin air, and
Correct,
Well,
yeah, it's of
We'll
course.
email it out to everybody, and then we'll add that for next time. Next time we're looking at COLAs. Okay,
Motion to
Alright.
adjourn, Freeman.
motion adjourned, Freeman,
Second.
perfect second. All in favor, say aye. Okay. We are adjourned at, is that 4:10?
Yeah.
Thank you very much.
Yeah.